So here's a toughie for you. Which side are you on? Cathie Wood, who thinks Tesla's stock is going to go up and up and up, or Michael Burry, who just recently shorted Tesla stock and thinks they're going to go down potentially up to 90% just this year alone. And in case you aren't familiar with these two high-profile investors, Cathie Wood of ARK Invest famously said on air that she believes Tesla will go to $4,000 a stock, and she said that when they were only trading at about $300.
And that is Tesla, because you made a lot of waves by attaching a $4,000 price target to the shares at one point.
Yes.
And just last month, January 2021, that prediction came true when Tesla stock hit $800 a stock, which is $4,000 adjusted for the pre-reverse split from last year where they split their stock 5-for-1. So 800 times 5, 4,000, Cathie Wood on the money. And then 2 years later, she said this.
Let's bring in ARK Invest CEO and founder Cathie Wood. Cathie, welcome. I know 15,000 a share is not your base case.
No.
It's your reach case. What is your base case of where this $700 stock is in 4 years?
Yes, the base case, it's a 5-year target, so the end of 24, it's $7,000.
And she said that when the stock price was around $700, and if she can get it right once, can she do it twice? Well, Michael Burry has other ideas sitting on the other side of the fence. He thinks there's absolutely no chance. And in case you don't know who Michael Burry is, he's the real person that Christian Bale's character in the movie The Big Short is based on, about the American housing crash in 2007-2008. Burry decided against all odds to short America's housing market despite no evidence that it was ever in trouble. And he turned out to be absolutely right, pocketing $700 million for his investors and $100 million for his own bank account. So now we face an interesting conundrum, and we can't agree with both of them because they're on the opposite side of the fence. So whose side are you on? Well, let me go over the entire situation for you today, and hopefully you can make a more educated decision to make up your own mind. So first of all, here's how all of it came to light in December 2020, and it all started with a tweet, as all good things do, at least these days. So in this tweet, Burry wrote, "So Elon Musk, yes, I'm short Tesla, but some free advice for a good guy? Seriously, issue 25 to 50% of your shares at the current ridiculous price. That's not dilution. You'd be cementing permanence and untold optionality. If there are buyers, sell that. Hashtag Tesla souffle." And hashtag Tesla souffle was actually in reference to an email that Elon Musk sent to investors regarding the fact that if things don't go to plan over the next year, it could crumble like a Tesla souffle. Now, this is something that we have seen on more than one occasion from more than one person, people betting against Elon Musk and betting against Tesla, something that has been proven very, very difficult. He has an excellent track record. Sure, he makes some outlandish claims. He makes some big, bold predictions, sometimes more and faster than we would expect, but somehow he always seems to deliver. So going up against him is usually not recommended. But if there's anyone who can do it, it's probably the person who bet against America single-handedly and won. So just very quickly, let me fill you on shorting, and basically it is betting against a company's success. Instead of buying a stock at a low price with hopes that it will climb, you borrow shares through a broker so that you can then sell those shares while the stock price is high. Then when the stock price drops, you buy those shares back at the low price and return the borrowed shares back to the broker, and then you keep the profits. So it's really the opposite of what we normally do. Now, something that's very clear to me, both in the tweet and also the data and research that he's compiled, which we'll go over in a minute, I can tell that he doesn't not believe in Tesla long term, he just has some short-term concerns about the stock price and how overvalued he thinks it is. And he does back that up with some of his own research, which we'll have a look at right now. All right, so here's the spreadsheet, and we can see that this is showing total revenues, market cap, and EBIT from 32 large automakers and compared them to Tesla from the previous 12-month period. And not only did he compare them, but he actually added up all of the 32 manufacturers' figures together to show how unbalanced these results are. So adding up all of the revenues came out to $2.3 trillion with a market cap of $991 billion and an EBIT of $101.9 billion for the 32 automakers combined. EBIT, by the way, is earnings before interest and taxes. Now, this is where it gets interesting, and Michael Burry's story starts to come together. We can see his reasoning. If we look down the spreadsheet to Tesla's revenues, it's $24.5 billion. The market cap is $646 billion, and the EBIT is minus $70 billion. Now, to put that into context, Tesla's revenue is 94 times lower than the 32 manufacturers combined, but the market cap is only 35% lower. a huge discrepancy. So think about it. How can that be? How can their market cap be so close to all these major manufacturers combined while having 94 times less revenues? Well, that's Burry's entire point. He feels that Tesla investors are behaving as a cult and jumping on the bandwagon based on hype for future performance while ignoring current performance. The data suggests that the current results of Tesla are not that important to people. They're looking forward into the future to what Tesla might achieve, and that concerns Burry because they haven't achieved it yet. He feels that Tesla isn't nearly as profitable as they should be to warrant their market cap and their stock price. He believes they rely too heavily on short-term auto sales just to remain barely profitable. Basically, he treated the house market as if it was in a bubble, and now he's treating Tesla as if the stock price is in a bubble. And what do bubbles do, my friends? They burst. And I think he feels the same way about Tesla. He's identified a short-term concern, he wants to cash in, and then it can go back to normal. Now, crazy as this may seem, I can actually see some merit in both sides of the argument, both Cathie Wood's perspective and Michael Burry's perspective. But I'm going to defend Elon and Tesla first. And by the way, I'm a big fan of Tesla, love what they're doing, love their future prospects. I think it's a fantastic company. So I'll defend them first. Now, while the numbers he crunched had a lot of logic and reasoning behind them, there's one key factor that I think he was missing, and that is that Tesla is not like other auto manufacturers. Tesla are just as much a hardware company as they are a software company, whereas these other manufacturers are miles behind in the autonomous driving. They're miles behind in the battery production. They're miles behind in almost everything to do with electric vehicles. And let's not forget that Tesla's fast becoming one of the biggest battery manufacturers in the world, and also can put up gigafactories in what feels like 2 minutes, take them from a skeleton to fully operational in what feels like another 2 minutes. So it's very hard to make a direct comparison between these companies because they're not really playing the same game. While in the other camp, I can acknowledge that it is very difficult to understand how Tesla, at their current sales figures, their current profitability, have the market cap and the stock price that they do. It is very hard to justify, no matter how exciting their future is. Future is not proven. That's all speculation. And while it does look incredibly promising, it's still speculation. I mean, just take a look at this for a second. And this is only a very basic valuation tool, but the average PE ratio, we're looking between 15 to 40, sometimes getting up to 50 or 60. But take a look at this and you'll see just how skewed these results are. So like I said, the typical PE ratio is round about 15 to 40 most of the time, and Tesla's PE ratio is 1,280, which means that investors are willing to pay 1,280 times their earnings just to own stock in the company. And to give you a comparison, Apple's PE ratio is 36, Amazon's is 78, and General Motors is 12. So you can see that something in that picture seems off. And while that doesn't guarantee anything, it doesn't guarantee a market collapse, it just might suggest that something is a little bit fishy. So tell me, are you team Wood and Musk, or are you team Burry? Me personally, I love everything Elon Musk does, and it's impossible to bet against him. However, when does Michael Burry ever get it wrong? And when he gets it right, he gets it all the way right. All right, guys, help support this channel by hitting the thumbs up button and subscribing if you want to hear more from me. It's been a pleasure, and I'll catch you next time. See ya!